we perform the service of a third-party unrelated trustee. So this trust is set up only to do business with this husband and wife, and their children can step into their shoes and keep it going for as long as they want. But most people will do this fact pattern, John. They'll let the full principal go in, and they'll just live off the interest.
Brett, can you walk us through a real life example where a sales trust made a major difference for a client exiting a business or real estate?
Yeah, we'll start with business, and then we'll go real estate, and then we'll go Bitcoin, okay? So on the business front, we just helped a client exit out of their dental practice business out of Oregon. It was a $16 million exit, and a husband and wife, and they started out as dentists, and then they had their first practice, and then they compounded to about 6 practices, and they sold it to a big group. And so they're facing 10% of the state of Oregon and 20% federal, so about 30%, okay, on the sale. So if you look at that tax burden, it's pretty simple. You take 16 million by 30%, and you're looking at the tax liability of approximately $4.8 million, right? So you go, on one front, I can pay 4.8 million in tax and have 16 minus that, or I can have the full 16 in this trust that's owed to me over time. This is how this works. So instead of selling it and taking all of the cash all up front, they sold it to the trust in exchange for a promissory note. So the trust issued them a note, right? In other words, they became the bank to a trust. This trust owes them the money. They sold it to the trust, and the trust is going to pay them back. Now, I think on this promissory note, we wrote it around 9% or 10%. So the note is set, and now it's going to pay them in installments, and they'll pay slowly over time. So that's what happened, and the trust ultimately sold it to the buyer. So that they get the same thing they bargained for. But what happened here, John, is the trust bought and sold for the same price, so the trust had no gain. So this is how it works, right? It's really beautiful. Now, there's a third-party unrelated trustee. That's our role here. We're kind of like a third-party qualified intermediary, a 1031 exchange company. We're kind of like an IRA company. We're kind of like a 401k company. We're kind of like a lot of these things, but we're none of those. But we have some similarities. So we perform the service of a third-party unrelated trustee. So this trust is set up only to do business with this husband and wife, and their children can step into their shoes and keep it going for as long as they want. But most people will do this fact pattern, John. They'll let the full principal go in, and they'll just live off the interest. So for this particular couple, it's $16 million, and let's just use a 9% interest rate. That's about $1.44 million per year, or that's about $120,000 per month. Now realize they've been building their business for the last 7, 8, 9 years, blood, sweat, and tears, all of their time and energy. They've been taking a fair salary, right? Equitable salary to keep their business growing and, their employees and expansion. But at the same time, this changes their life, right? No longer do they have to wait to have the freedom and flexibility with their wealth. They, with investing in tax deferral, are now able to unlock that truly passive income, right? And so that's the first story. It's fantastic. We've invested into passive real estate, mostly passive private debt right now, which is so attractive. But we're also putting stuff into multifamily deals that have dropped in value drastically. We put some into the stock market. We've put some into money market accounts. In other words, we diversified and we've dollar cost average. And this is the beauty of the deferred sales trust. It's not just a tax deferral on the capital gains tax. It's also ability to invest at optimal timing, which is really, really cool in a diversified way. The second thing I'll leave with you on this deal is they are staying with their company for a couple of years. In other words, they sold it to the company, but they're staying on for 2 to 3 years, to work with the company until they fully exit out. Okay, so they're still going to get paid salaries over the next couple of years. Well, guess what? What's neat about the trust is the trust can delay that interest payment. So although it's set at 9% or about 1.4 million a year, they can say, hey, I want to delay that, and therefore they're delaying their income tax. So for at least 2 years, they don't take any distribution from the trust. They have no state income tax, no federal income tax from the trust. Their working years still have some tax, right, which is a part of it. And then when they stop working, guess what? We turn the trust on to start paying them, right? So you see how we can make this thing an investment and not an expense? We can get an extra ROI there because they can kind of control the, think of it like a throttle or a spigot of water, right? You can turn it on or turn it off in a flexible manner based upon your unique, tax situation.